Hi everyone, in this video we're going to discuss non-arm's length transactions for depreciable assets, and we're going to apply the rules in ITA 13.7e. Now remember back to a prior video where we discussed the non-arm's length transfer of non-depreciable assets. You might remember that we had a video with an individual that owned some shares. They had a related person in their life, in this case a sibling, and they wanted to transfer the shares to that sibling. And then later on, that sibling was going to sell the shares to an unrelated third party. We could take a moment just to focus on this relationship between the siblings. We talked about in that other video what would happen with this non-depreciable asset transfer between related persons if the asset was transferred above fair market value, at fair market value, or below fair market value. And those rules are all covered in ITA 69. This video is going to focus more on what to do with a non-arm's length transfer of depreciable assets. We're going to look at ITA 13.7e, or specifically we're just going to apply the rules from 13.7e. And for the sake of simplicity, in intro tax, these transactions will occur at fair market value. Let me show you what I mean. It's time for an example. And with this first example, we'll look at a situation where the transfer price is less than the transferor's capital cost. Let's look at a fact pattern. Meet Joey. Hi, Joey. Joey owns a depreciable asset. The capital cost is $123,400. The undepreciated capital cost is $87,323. Now let's meet Joey's father. Hi, Dad. You know, for tax purposes, Joey and Joey's father are considered related persons. The asset is going to be sold to Joey's father. The transfer price is $53,200, and that's equal to the fair market value at the time. That's what a picture could look like of this fact pattern if you chose to draw it out. But now let's zoom in and focus on the tax consequences for each individual. Now this fact pattern doesn't tell us what class the asset's in, but let's just say we have some CCA class, and this asset is the last asset in the CCA class. We were told what the undepreciated capital cost, or the opening UCC, was. It was $87,323. And then we also know it was sold to Joey's father. There was a disposition. And when there's a disposition, we need to take from the CCA class the lesser of the proceeds of disposition, in this case the selling price of $53,200, and we compare that to the capital cost of $123,400. Clearly, the smaller of those two numbers is $53,200. This leaves us with $34,123 in the class, but there are no assets left in the class. We call this a terminal loss, and that will be a deduction for tax purposes for Joey. We could also take a quick look at Joey's subdivision C tax consequences. Remember, his proceeds of disposition in this case are the fair market value of $53,200. His adjusted cost base is his original cost of $123,400, and this results in a negative amount of $70,200. Now, that is not a capital loss because this is going to be denied. You cannot have a capital loss on depreciable property. Now, what about Joey's father? This is where we're going to apply one of the rules in ITA 13 subsection 7 paragraph E. We need to be cognizant of the fact that when there is a non-arm's length transfer at a value that is less than the transferor's capital cost. In other words, what's happened in this exact situation? The transferee's cost, Joey's father, the transferee's cost for CCA and capital gain calculations is deemed to be equal to the transferor's old capital cost. This means the capital cost for Joey's father is $123,400. The UCC for Joey's father will be $53,200, or the fair market value for this transaction, and the adjusted cost base for Joey's father will be $123,400. In this example, the transfer price is going to be greater than the transferor's capital cost. Let's take a look. Remember Joey? Well, Joey owns a depreciable asset. It's a different asset this time, but he still has one. The capital cost is $87,600. And the undepreciated capital cost is going to be $62,246. Let's meet Joey's mother. Hi, Mom. For tax purposes, Joey and Joey's mother are considered to be related persons. The asset is sold to Joey's mother. The transfer price is $92,500, which is equal to the fair market value at the time of the transfer. Again, we'll assume that this asset is the last asset in the class for Joey. Let's focus on the tax consequences for each individual now that we've seen the picture. Again, we were not told what class this asset was in, but we were given sufficient information to figure out what to do with the CCA class. We were given the opening undepreciated capital cost of $62,246, and we know the asset was sold. So we will take the lesser of the proceeds of disposition of $92,500 and the capital cost of $87,600. The lesser of those two amounts is $87,600. This results in a negative balance in our CCA class, which we can't really have. That number needs to be brought back into income, and it's known as recapture. That's the subdivision B consequence for Joey. Looking at subdivision C, we know that Joey sold an asset for $92,500, the fair market value at the time. His adjusted cost base was $87,600 for a capital gain of $4,900. His taxable capital gain is then $2,450. That's assuming an inclusion rate of 1/2. Now we apply a rule from 13 subsection 7 paragraph E to figure out Joey's mother's tax values. Essentially, when the transfer occurs at a value that exceeds the transferor's capital cost, like this situation, the transferee's cost for CCA and recapture calculations is deemed to be the following. And we have a formula. The formula is we have the amount which is equal to A plus 1/2 of B minus A, where A is equal to the transferor's old capital cost, and B is the transferee's cost, or their fair market value that they had to pay in our introductory tax examples. Let's apply this formula to Joey's mother. The transferor's old capital cost was $87,600. The fair market value at the time of the transfer, and remember these transfers in our course will occur at fair market value, was $92,500. That means we can take $87,600 and we could add 1/2 of $92,500, subtract $87,600. And that will equal a capital cost for the purposes of CCA and recapture of $90,050. The undepreciated capital cost will be the same amount. The adjusted cost base, however, and pay attention to this, is different. It's going to be $92,500. It looks similar, but it's not the same number. $92,500 which is the fair market value at the time of transfer. This is a very complicated provision to read in the Income Tax Act, so I've just provided an overview of how to work through the calculations in this sort of situation. That's all I have for you for now. So until next time, thanks so much for watching, and happy studying.